Now we will learn the second part of management accounting. Cost summaries, or basically the accountants call this as cost card. Generally, the cost of a product, a unit, cost unit, let's say a pen or pencil or whatever, or the cost of a particular function is given in the particular format. First, you start with the direct cost, the cost that change with the level of output. Direct material cost, direct labor cost, and direct expenses. So we learned that the total of all these three as the prime cost. Then add to that production expenses, production overheads, such as the factory rent, the production department supervisor's salary, like production overheads. Add to that, then you will get total production cost. To the total production overheads, add non-production overheads. Then you will get the total cost of the product. This is known as the cost summary, or sometimes the cost card. Direct cost, add everything, and we will get the prime cost, primary cost, plus the production overheads. Then add non-production overheads to the production overheads, you will get the total cost of the product or the function. Then pricing. After learning the cost, we can move on to the pricing. Once the total cost is known, it is possible to set appropriate prices. Generally, the price is set by adding a profit margin to the cost. So if the cost is 100, profit margin is, let's say, 20%. So 100 plus 20, the price will be 120. That's the pricing. A wide variety of pricing strategies could be used. In setting these prices, however, producers of goods and services need to take several factors into consideration. When you are selling a particular product and when you are setting a particular price, not only the cost that you have to consider, addition to the cost, some more facts you have to consider. First, cost. The second one, competition, pricing and activity. See the pricing of your competitors. So better to price in accordance with the competitors. Sometimes some products have a perceived value, that means price is somewhat increased, giving that some kind of a value is there from its pricing. Sometimes branded products, people say not because of the cost that they are so costly, but because of the value, the brand, perceived price. Or the government influence. Sometimes government input maximum price ceilings. If that is the case, even though your cost is so much, you can't sell beyond the government's price ceiling. Or trade requirements or volume targets. If you want to increase the volumes, sometimes you have to reduce the prices as well. So once the cost is identified, very important that you have to set the pricing as well. Now, after setting the price, organizations will use different pricing strategies. Now, given here are some pricing strategies that they use for their products in the market. Number one is the penetration pricing. Penetration pricing means you set the price in such a way with some special offers in order to grab the market more quickly. This was used by generally utility companies like telecommunication service providers entering into a deregulated European market. So penetration pricing means you will price the product in such a way, providing some promotional offers in order to grab the market more quickly. Discounted prices. This is you tactically reduce the price occasionally or providing a discount to get the competitor's market share. This is discounted prices. Price skimming. Price skimming means starting with a higher price to get the early adopters. Start with a higher price to get the early market capturing. When you are the early market goods provider, you start with a higher price and gradually reduce when other competitors are coming in. Starting with a higher price and gradually reduce the pricing when other competitors are also coming. This is called as price skimming. Premium pricing. Premium pricing means charging a higher price for a perceived value. Example, branded products like Rolex, premium pricing, or cost plus pricing. You calculate the cost and put your margin, your profit, and plus that particular profit, you will price the product. Does not work in a dynamic market, but sometimes used in government controlled market economies. Going rate. That means fitting the market price of the competitors like for like comparisons. That means you price your product with the price of your competitors. Target pricing. Fixing price by market segments or distribution channels. You will have different pricing for the same product for the same target market. Or price discrimination is also like that. Fixing a price too high or low to exclude certain customers or to get some customers sold. Different targeted customers you have, different price discrimination. Like what the cinemas are doing. You have different prices, balcony different price, then the normal seats different price, but the same people are watching the same movie. That's price discrimination. Quantum pricing. Initially fixing prices high and lowering these when the sales are occur. Odd number pricing. Psychologically ending the price with a 9, making it appear to be disproportionately cheaper, like which is priced like 9.99, which gives actually the price is £10, but you price it at 9.99, which is illusional, odd number pricing. So these are the pricing strategies generally a company is using. Penetrative pricing, discount pricing, skimming, likewise. Finally, we will learn the cost behavior. According to the behavior of the cost, it is divided into 3 types: fixed cost, variable cost, and semi-variable cost. A fixed cost is a cost that is fixed for the particular accounting period. Fixed cost is a cost that is fixed for a particular accounting period. That means that particular amount of expenditure is stable, static for a particular year, particular month. Fixed cost. Example, rent of a building is fixed for a month. Rent for a machine is fixed for a month. Salary of an office worker is fixed for a month. So if you put that fixed cost on a table, on a graph, it's like this. It's like the cost is static. Cost is stable for a particular period. Cost is stable for a particular period. So the beauty of the fixed cost is stable even though how your level of activity is. If your production increases from 1 unit to 100 unit, example, your fixed cost will be remaining same. Example, if you produce 1 unit, still you have to pay distinct amount of rent to your landlord. Even if you produce 100 units, still you have to pay the same rent to your landlord. Take that. So fixed cost is a cost that is fixed for a particular accounting period. It doesn't change with the number of units you produce. Example, rent, salaries of your office staff, advertising cost, insurance, like that. Then the variable cost. Variable cost is quite the opposite of fixed cost. It's like when you produce nothing, there is no variable cost. But when the production increases, the fixed cost increase, proportionately. That varies directly with the level of output. Example, raw material cost. In raw material cost, if you are producing pens, the raw material, the plastic cost for 1 unit, when you produce second unit, it will increase. The third unit, it will increase again. That's the variable cost behavior. So the graph is like this. If you have zero level of activity, if there is zero level of activity, there is no cost. But when the production is increasing, the variable cost is increasing. The third one, semi-variable cost. Semi-variable cost has the functions of both variable and fixed characteristics. Semi-variable costs start with a fixed component, and when the level of activity, number of units produced increase, the cost increase. Example, your phone bills and utility bills. You have a fixed monthly rental, and when the production is increasing, the cost will also increase. Example, utility bills and phone bills, where you have a fixed component, the monthly rental and the usage charge. So cost behavior, you have fixed cost, variable cost, as well as semi-variable